Starting a business is a thrilling adventure, but it often comes with a daunting question. How am I going to fund this? The world of startup funding can seem like a labyrinth of options, each with its own set of pros and cons. Whether you're an aspiring tech mogul, a small business owner, or a social entrepreneur, this video of funding avenues will help you chart a course to success. Bootstrapping. Let's start with the most resourceful way to fund your startup: bootstrapping. In essence, bootstrapping means using your own savings and revenue generated by the business to fund its growth. It's often the initial step for many entrepreneurs. Pros of bootstrapping: independence. Bootstrapping allows you to maintain full control of your business. You make the decisions without external influences. Conservation of equity. Since you're not giving away shares to investors, you preserve your equity, which could be very valuable in the long run. Focus on profitability. Bootstrapping forces you to be frugal and prioritize profitability from the start. This can lead to a more sustainable business model. Cons of bootstrapping: limited resources. You're constrained by your own financial resources, which can limit the pace at which your business grows. Risk: your personal finances are on the line, and the risk can be substantial. If the business fails, you may lose your savings. Slower growth. Without external capital, your business may grow more slowly, potentially missing out on market opportunities. Friends and family. When bootstrapping doesn't provide enough runway, turning to friends and family is a common next step. These are the people who believe in you and your vision. Pros of friends and family funding: quick access. Securing funding from friends and family can be faster and less bureaucratic than seeking external investors. Lower interest rates. Friends and family may offer more favorable terms, such as lower interest rates or longer repayment schedules. Flexible agreements. You can negotiate terms that suit both parties, often with more flexibility than institutional investors. Cons of friends and family funding: personal relationships. Mixing business with personal relationships can strain those connections if the business faces difficulties. Risk to their finances. If your startup fails, your friends and family may suffer financial losses, leading to potential tension. Limited capital. Friends and family may not have deep pockets, limiting the amount of capital you can raise this way. Angel investors. Angel investors are individuals who provide capital to startups in exchange for equity ownership. They're often successful entrepreneurs themselves and can bring valuable mentorship along with their money. Pros of angel investors: expertise. Angel investors typically have industry experience and can provide guidance and mentorship. Network. They often have extensive networks that can help your business in terms of partnerships, customers, and talent acquisition. Relatively quick process. Raising funds from angel investors can be quicker than dealing with venture capital firms or other institutions. Cons of angel investors: equity dilution. Giving away a portion of your company means you'll have less ownership and control. High expectations. Angel investors expect a return on their investment, which can lead to pressure for rapid growth and profitability. Limited capital. While they can provide a significant boost, individual angel investors may not have as much capital as venture capital firms. Venture capital. Venture capital (VC) firms are a common route for tech startups and high-growth companies. These firms manage pools of money from various investors and deploy it into promising startups in exchange for equity. Pros of venture capital: large capital injection. VC firms often invest substantial amounts, enabling rapid scaling and market expansion. Expertise. They bring deep industry knowledge, connections, and business acumen to the table. Validation. Securing VC funding can be a signal to the market that your startup is a serious player. Cons of venture capital: equity loss. You'll likely give up a significant portion of your company, and VCs may demand board seats and decision-making power. Pressure for growth. VCs expect high returns and may push for aggressive growth, sometimes at the expense of profitability. Rigorous due diligence. VC deals can take time, as they involve extensive due diligence and negotiations. Crowdfunding. In recent years, crowdfunding has emerged as a viable way to fund startups. Platforms like Kickstarter, Indiegogo, and equity crowdfunding sites allow entrepreneurs to raise money for a large number of individuals. Pros of crowdfunding: access to capital. Crowdfunding can provide capital quickly and without the need for extensive negotiations. Market validation. A successful crowdfunding campaign can validate your product or idea in the eyes of potential customers. Community building. It helps you build a community of early adopters and supporters. Cons of crowdfunding: all or nothing. Many crowdfunding platforms operate on an all-or-nothing basis, meaning if you don't reach your funding goal, you get nothing. Time-consuming. Running a successful crowdfunding campaign can be time-consuming, requires significant marketing and outreach efforts. Equity crowdfunding risks. Equity crowdfunding involves giving up ownership, and if your company becomes highly successful, those small equity stakes can become expensive. Bank loans. Traditional bank loans are a tried-and-true method of funding for many small businesses. They offer access to capital but require repayment with interest. Pros of bank loans: control. Unlike equity financing, you retain full ownership and control of your business. Stable interest rates. Interest rates on bank loans are usually stable, making it easier to budget for repayment. Diverse loan types. There are various loan options, such as SBA loans that cater to different business needs. Cons of bank loans: collateral. Most bank loans require collateral, which can put personal assets at risk if the business fails. Strict requirements. Banks have strict lending criteria, making it challenging for startups with limited operating history to secure loans. Debt repayment. You'll have to repay the loan with interest, which can be a burden on cash flow, especially in the early stages. Corporate partnerships. Large corporations often seek innovative startups to partner with or invest in, creating win-win scenarios for both parties. Pros of corporate partnerships: access to resources. Partnerships with established companies can provide access to resources, distribution channels, and expertise. Validation. A partnership with a reputable corporation can enhance your startup's credibility. Funding and support. Some corporations offer funding, mentorship, and guidance in exchange for strategic alignment. Cons of corporate partnerships: loss of independence. You may need to align your startup's goals with a corporate partner, potentially limiting your independence. Complex negotiations. Negotiating partnerships can be complex, and the process may take time. Cultural differences. Startups and large corporations often have different cultures and work styles, which can lead to challenges. Revenue-based financing, paying back with profits. Revenue-based financing is a relatively new funding model where investors provide capital in exchange for a percentage of the startup's future revenue. Pros of revenue-based financing: alignment of interests. Investors benefit when your business succeeds, creating alignment between your goals and theirs. Cash flow friendly. Repayments are tied to your revenue, so they adjust based on your business's performance. No equity dilution. You don't give up equity. Instead, you share a portion of your future revenue. Cons of revenue-based financing: cost of capital. While it's not technically interest, revenue-based financing can be more expensive than traditional loans. Reporting requirements. Investors often require regular financial reporting, which can be a burden. Limited funding. The amount of capital you can raise through revenue-based financing depends on your projected revenue. The world of startup funding is a vast landscape with myriad paths to explore. Your choice of funding should align with your business model, goals, and risk tolerance. Remember that no single funding source is a one-size-fits-all solution. It's often a combination of different funding options that help startups thrive. When are you starting your business? Let us know in the comment section below, and make sure to like the video and subscribe to the channel.